Yesterday, the euro extended its correction against the US dollar. Likewise, the British pound tested weekly lows before rebounding slightly ahead of the release of key macroeconomic data. On Thursday, traders digested statistics on economic output in the euro area. In the third quarter of 2023, seasonally adjusted GDP fell by 0.1% in the eurozone and remained stable in the eurozone compared to the previous quarter. On an annual basis, GDP was 0% in both the eurozone and across the wider bloc, dampening optimism about the ECB's future monetary policy. Although some expect the regulator to slash interest rates as early as March 2024, the majority of economic agencies see the first rate cut in June. The ECB itself is in no hurry to ease policy. Market participants also received data on US initial jobless claims. The number of Americans filing for unemployment benefits last week was barely changed at 220,000. Given that the yield on the benchmark 10-year Treasury bond is falling at a rapid pace, it can be assumed that Wall Street is betting that the Fed will start cutting interest rates in March next year, despite recent comments by Fed Chair Jerome Powell on the need to keep monetary policy tight. Today's macroeconomic calendar includes data on Germany's consumer prices. In November, German inflation is expected to ease by 0.4% compared to the previous month and 3.2% year-on-year, which may weigh on the European currency. The focus of market participants will be on US jobs data. The unemployment rate is forecast to remain unchanged at 3.9% in November. US non-farm payrolls are anticipated to rise by 185,000 in November, following an increase of 150,000 jobs in October. In the event of a disappointing report, the greenback may come back under pressure, thus enabling the euro and the British pound to enter a bullish correction at the end of the week. Furthermore, traders may take notice of the University of Michigan's preliminary reading of its Consumer Sentiment Index. If US jobs data comes out upbeat, this would mean that there is no need for the Fed to end its aggressive tightening cycle and rush to cut interest rates. In this case, the dollar may extend gains against risky assets. And now let's move on to technical analysis. In anticipation of US jobs data, market volatility is likely to be subdued in the first half of the day. A decline, followed by a false breakout at 1.0770, will create a strong buy signal, thus driving the price up to 1.0790 and 1.0813. The euro will hardly be able to overcome 1.0813, so it will be possible to go short at this level. Alternatively, if the price falls below 1.0770 following upbeat data on the US labor market, the volume of short positions will increase, dragging the euro down to 1.0734 and 1.0706. At the level of 1.0706, I recommend going long on a rebound to catch an intraday correction of 25-30 pips. Long positions at 1.0734 can be considered only amid a false breakout. In a bull case scenario, if the price breaks through 1.0813 and consolidates above this mark, the European currency is expected to climb to 1.0838 and probably 1.0869. At the level of 1.0869, it would be a wise decision to go short on a rebound, counting on an intraday correction of 25-30 pips. Going short at 1.0838 and 1.0813 will be relevant in the event of a false breakout. Speaking of the British pound, the level of 1.2573 acts as the middle line of the channel. A false breakout at 1.2573 and 1.2544 will make it possible to buy the pair to push it up to 1.2608. If the price stays firm above this level and US jobs figures turned out to be weak, sterling will have a chance of rising to 1.2646. At this mark, traders are recommended to go short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.2608 can be opened only amid a false breakout. If bears take control of 1.2573 supported by US statistics, and the price fixes below this mark, the British currency will most likely dive to 1.2544 and even 1.2511, where traders may go long on a rebound, expecting a rise of 25-30 pips. Best of luck!